In the cryptocurrency sphere, the development of decentralized finance has recently taken center stage. While the market hype surrounding DeFi and liquidity mining has since cooled down a bit, non-fungible tokens, also known as NFTs, have regained much of the popularity they saw at the height of CryptoKitties' popularity back in 2017. So with non-fungible tokens on the rise, many believe that they have great potential and have a very bright future. And in today's video, we will be discussing exactly why that is. But before we get into the video, don't forget to leave a like and subscribe to the channel with notifications turned on so you don't miss any of the new videos we post. For those of you who may not know what NFTs are, here's a short explanation. Non-fungible more or less means that it's unique and can't be replaced with something else. For example, a Bitcoin is fungible. Trade one for another Bitcoin and you'll have exactly the same thing. A kind of trading card, however, is not fungible. If you traded it for a different card, you'd have something completely different. At a very high level, most NFTs are part of the Ethereum blockchain. Ethereum is a cryptocurrency, like Bitcoin or Dogecoin, but its blockchain also supports these NFTs, which store extra information that makes them work differently from, say, an ETH coin. It is worth noting that other blockchains can implement their own version of NFTs. Long story short, you gave up a Squirtle and got a 1909 T206 Honus Wagner back. So why do these blockchain-based NFTs matter? Well, non-fungible digital assets have been around since the advent of the internet and range from domain names to e-tickets to account handles on social media networks. These assets possess their own characteristics and are not interchangeable. Furthermore, one user usually cannot easily transfer a rare item from an online game to another user, and there exists a lack of proof over the ownership of the particular item. This is where blockchain-based NFTs come into play. The use of blockchain technologies with NFTs has many benefits and brings the following features to digital assets: an ERC-721 token standard, proof of ownership, increased transferability and liquidity, and the mitigation of counterfeit risk. As first introduced by CryptoKitties in late 2017, ERC-721 is the most common token standard for non-fungible tokens. There are two main differences between ERC-721 and ERC-20 token standards. Firstly, ERC-20 tokens are divisible, while ERC-721 tokens are not. For example, users can purchase 0.5 units of Ether or UNI. However, under the design of the ERC-721 standard, users may only possess the whole unit of the token. Such indivisibility makes the ERC-721 tokens consistent with the nature of non-fungible assets. For instance, users cannot own half a kitten in CryptoKitties or claim 30% ownership of a digital collectible card. ERC-721 tokens are different from ERC-20 tokens in their ownership records. ERC-20 tokens only record the account balance of the address. On the contrary, ERC-721 tokens not only record account balances, but also maintain records of the token ID for each transfer. This feature is crucial for enhancing the transparency of non-fungible asset transfers. Each non-fungible token represents a unique asset and contains essential information, such as basic properties and ownership details. The ownership record of the asset is stored in the NFT, which is traceable on the blockchain. Another benefit of NFTs is that they allow their underlying assets to be transferred and traded easily across multiple ecosystems. Using in-game items as example, blockchains remove any intermediaries and serve as unified platforms for users to trade their items. For game developers, they can incorporate sophisticated trading capabilities such as eBay-style auctions and bidding into smart contracts. This makes blockchains one-stop platforms for users to trade, auction, and sell their NFTs. Additionally, the tradability of NFTs leads to higher liquidity as they can be traded in open marketplaces. Marketplaces for non-fungible tokens offer greater exposure to digital assets for a wider pool of buyers. Lastly, the use of NFTs helps mitigate the risk of purchasing counterfeit goods. Art is one field where this is especially useful. Each art collectible is assigned its unique identification in the non-fungible token, which allows people to prove the scarcity of the artwork. The blockchain serves as a publicly trackable database to show the entirety of the artwork's life. This helps to prove the authenticity of the artwork, as only the digital piece of the art is tracked on the blockchain. With all of these benefits in mind, let's take a look at the timeline of non-fungible tokens. In 2017, we saw the rise of CryptoKitties. Launched in late 2017 at the ETH Waterloo Hackathon, CryptoKitties is an Ethereum-based game that allows users to collect and breed their own digital cats. The tokens of the CryptoKitties are non-fungible, as each token represents a unique digital cat on the blockchain. The rarer the cat's characteristics, the higher price it could be sold for. CryptoKitties went viral due to its breeding and trading mechanisms. Eventually, there was a surging demand for for CryptoKitties, which led to the number of daily transactions on the Ethereum network reaching an all-time high. On the flip side, the CryptoKitties favor exposed Ethereum's lack of scalability. The growing number of users who were breeding and trading their cats led to a huge increase in transactions that needed to be executed on the Ethereum network. Because Ethereum can only handle approximately 15 transactions per second, most of the CryptoKitties transactions fell into the pool of pending transactions. The congestion on the Ethereum network popped the CryptoKitties bubble in early 2018. Despite this, CryptoKitties was the first NFT to attract mainstream attention and pioneered a Dutch auction contract, which then became one of the primary price discovery mechanisms for NFTs. In 2018, the interest in NFT investing grew. Despite the interest in non-fungible tokens cooling down after the CryptoKitties, the fundamentals of the NFT ecosystem have been growing since 2018 in two primary ways. Layer 2 games on CryptoKitties, which emerged in the NFT ecosystem in 2018 and refer to games that were built on top of CryptoKitties by third-party developers unaffiliated with the original game's team. The second way being through investment from crypto funds and venture capitalists. Then, fast forward to 2020s, where NFTs meet DeFi. 2020 was an explosive year for decentralized finance. While liquidity mining has cooled down after the release of Uniswap's governance token, Uni, yield farmers have turned their attention to NFTs. The yield farming of NFTs has primarily been pioneered by Rarible, an NFT marketplace. In fact, Rarible's governance token, Rari, in mid-July, resulted in an 814% price growth. The trading volume of NFT marketplaces also surpassed $7 million in September, of which Rarible accounted for 81%. Apart from Rarible, NFTs gained traction among the cryptocurrency community with the launch of the Meme token. Meme is an experimental protocol meant to integrate DeFi with crypto collectibles. Despite the project's slogan being "Don't buy Meme," it has gathered market hype and once reached a $48 million market capitalization. The Meme team has also collaborated with digital artists to allow users to stake their meme in order to participate in NFT auctions of their artwork. However, despite the popularity of yield farming NFTs, some believe that NFTs have not yet reached mass adoption levels of hype. But in better news, in the first half of 2020, the amount of US dollars transferred in the NFT ecosystem reached $233 million, up 52% from the entirety of 2019. With all of this said, many wonder whether or not NFTs are good enough to go mainstream. While NFTs have regained the community's attention once again since CryptoKitties in early 2018, there are still obstacles for NFTs to overcome before they go mainstream. One such obstacle concerns regulation. While NFTs grant holders the ownership of the underlying asset, there is no legal consensus of the nature of NFTs, whether they are utility tokens, security tokens, currency tokens, or belong to a new asset class. Henry Arcelanian, PwC's global crypto leader, stated that regulators have not come to a consensus on whether securities regulation should be applied to NFTs. He explained, "The jury is still out on whether NFTs should be or even can be regulated. Whilst most guarantee that there needs to be an oversight on the platforms where such NFTs are offered and traded, there is still no consensus on what type of NFTs should be regulated. Some believe that they should fall within the remit of securities regulations. Others argue that they are simply unique by their features and functions, and including them within the security sphere would not be appropriate." User experience is another area currently lacking in the NFT space. Despite the recent market hype, the ecosystem remains nascent. Crypto communities in general often do not understand the mechanics of NFTs and struggle to mint their own NFTs. Moreover, there is a lack of well-established NFT marketplaces. Finally, wash trading is also a concern in the NFT market, where traders may potentially engage in the creation of false demand for a particular token or intentionally mislead market participants. In a typical example of wash trading, the assets are exchanged between two wallet addresses frequently within a short time frame. When investors place the sell order, they will then place a buy order to fulfill their own sell order. Project teams and statistics platforms can help to mitigate the wash trading of NFTs. For project teams, they can impose higher market fees when designing reward structures. When the reward is less than the cost of the attack, traders will be less likely to perform wash trades. On the other hand, statistics aggregators and platforms need to develop methods to detect wash trading and facilitate price discoveries for NFTs. So, going back to the original topic, why the future of NFTs are looking bright, blockchains are expensive, slow, and confusing. It doesn't make sense to use one unless you want to get the added value that accompanies a feeling of true digital ownership. If you are selling a digital good that only exists in one domain and will go away if your app shuts down, don't use a blockchain. This is ultimately why NFTs have a bright future. Digital goods have always had an ownership problem, and NFTs are a way to fix it. With that said, that's going to wrap up this video. Thanks for watching.